Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Business Economics. In this lecture, we'll continue with Economics Chapter 5, that is Business Cycles. All the coming concepts will be covered in the coming series of the lectures. This is lecture number 2 of Business Cycles. Let us begin. In the last lecture, we had already covered the three stages of business cycle. The first stage that we have covered is expansion stage. The second stage was peak stage, and the third stage was contraction stage. Today we'll begin with the fourth stage, and that is depression stage. Depression stage. So depression is a severe form of recession and is characterized by extremely sluggish economic activities. During this phase of business cycle, growth rate becomes negative and the level of national income and expenditure declines rapidly. Demand for the products and service decreases, prices are their lowest and decline rapidly, forcing firms to shut down several production facilities. Since companies are unable to sustain their workforce, there is mounting unemployment that will prevail, which leaves the consumers very little disposable income. A typical feature of depression is the fall in the interest rate in the economy. With lower rate of interest, people's demand for holding liquid money, that is in cash, increases. Despite lower interest rates, the demand for credit declines because investor confidence has fallen in the market. Often, it also happens that the availability of credit also falls due to the possible banking and financial crisis in the economy. Industries, especially the capital and consumer durable goods industry, suffer from excess capacity, large number of bankruptcies and liquidation significantly reduce and the magnitude of trade and commerce. At the depth of depression, all economic activities touch the bottom and the phase of through is reached, that is depression. It is very agonizing period causing a lots of distress for all. The Great Depression of 1929 to 1933 is still cited for the enormous misery and human sufferings it is caused at that point of time. Let us do the notings. The contraction or downturn continues. The contraction or downturn continues till it reaches the lowest turning point. Lowest turning point, that is through. When the process of when the process of recession is complete, the severe contraction the severe contraction in the economic activities pushes the economy into the phase of depression into the phase of depression. Next, depression is the severe form of recession and is characterized by extremely sluggish economic activities at the lowest level at the lowest level. Next point, growth rate growth rate becomes negative growth rate becomes negative and the level of national income and expenditure declines rapidly declines rapidly. Demand for demand for products and services decreases decreases. Prices are at their lowest at their lowest and decline rapidly and decline rapidly, forcing the firms to shut down, several production facilities, several production facilities. There is more bankruptcy, there is more bankruptcy and closure of firms. There is more bankruptcy and closure of firms and closure of firms. Capital and consumer durable goods industry suffer from suffer from excess capacity. Unemployment increases. Unemployment increases leaving the consumers with disposable income, very little disposable income. Next, there is fall in interest rate. There is fall in interest rate and 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 people demand for people demand for holding liquid money, that is cash, liquid money, that is cash, increases. Despite lower interest rate in the society, despite lower interest rate, the demand for credit, the demand for credit declines due to pessimistic approach of business firms, business firms, reduction in investors' confidence, reduction in investors' confidence, or possible banking and financial crisis. Banking and financial crisis. Financial crisis. Next, at the depth, at the depth of depression, at the depth of depression, all economic activities, all economic activities touch the bottom, and the phase of through is reached, is reached. The next step is recovery stage, recovery stage, the business cycle. The economy cannot continue to contract endlessly. It reaches the lowest level of the economic activity called through and then starts recovering from there. Through generally lasts for some time and marks the end of pessimism and the beginning of optimism starts from there. So this reverses the whole process. The process of reversal is initially felt in the labor market. Pervasive unemployment forces the worker to accept wages, lowers the prevailing rates. The producers anticipate the lower cost and the better business environment. A time comes when the business confidence takes off and gets better and better. Consequently, they starts to invest again in the market and build more stocks, more inventory. The banking system starts expanding credit facilities. Technological advancements require fresh investment into the new types of machines and the new types of capital goods. Employment increases, aggregate demand picks up, prices gradually rise. Besides, price mechanism acts as a safe correcting process in a free enterprise economy. The spurring of investment causes the recovery of the economy. This acts as a turning point from depression to expansion. Depression to expansion. And investment rises, the production increases, employment improves, and income improves, the consumers begin to increase their expenditure. Increased spending causes the increased aggregate demand, and in order to fulfill the demand, more goods and services are produced. Employment of labor increases and unemployment level falls. The expansion takes place in the economic activity. It is re-emphasized that no economy follows a perfectly timed cycle, and that is the business cycle are anything but regular. They vary in intensity and length. There is no set pattern which they follow. Some cycles may have the longer period of boom, other than may have longer period of depression. But there could not be any cycle which would be very stagnant and that would not change. The business cycles would contain a situation of depression, boom, recovery, expansion. Many a times it happens that expansion period would be so long, the recovery period would be a bit shorter, the boom period would be so high or so long, but there can't be a business cycle where all the period would be stagnant and there won't be any changes. So if right now the situation of boom is there, it is sure that this situation is not going to be for lifelong. So there would be a depression time which is going to come. It will recover again. Again, the expansion will happen. The peak point will be reached. The boom point will come. The recession will come. Slump should be achieved. And after that, again, expansion will happen. And this is the whole process of business cycle. Let us take some notings, like how does the economy recover from this situation. So you can write over here, how does the economy recover? How does the economy recover? The economy cannot continue to contract. The economy cannot continue to contract for uncertain period of time, long period of time. It reaches to the lowest level of economic activity called through, and set a better standard of recovering. of recovery. Through last for some time and and marks the end of pessimism. Marks the end of pessimism and the beginning of optimism. Next point. The process of reversal is first felt in the labor market. Pervasive unemployment forces the worker forces the worker to accept wages lower than the prevailing rates lower than the prevailing rates. Producers anticipate producers anticipate lower costs lower costs and and better business environment. Better business environment. Next, business confidence. Business confidence slowly increases. Consequently, consequently, firms start to invest again. Firms start to invest again and to build inventories. Build inventories. Technological advancements technological advancements requires fresh investment requires fresh investment into new types of new types of machines and capital goods and capital goods. this turns this turns the economy in a positive manner, and the expansion starts. And the expansion starts. Banking system in the economy now slowly starts expanding. Credit matching with the business confidence level. Business confidence level. Next, as investment rises, as investment rises, there is increase in production level. There is increase in production level. Increase in employment. Factor payments. Increase in disposable income. Disposable incomes. Consumer spending. Aggregate demand. Aggregate demand, etc. To meet the aggregate demand, to meet the aggregate demand, more goods and services, more goods and services are produced. Employment of labor increases. Employment of labor increases. Unemployment level falls. Unemployment level falls. And expansion takes place. Expansion takes place in the economic activity. In the economic activity, you can write over here a recovery basically a recovery occurs when real national output picks up. from the through reached at the lowest point of the recession. The pace of recovery depends in part of how quickly aggregate demand starts rise starts to rise after the economic downturn, and the extent to which producers raise output raise output and rebuild their stock level in anticipation of a rise in demand. Okay, so we'll see the next concept now. These are indicators. These are indicators are very difficult to predict the turning points of business cycles. Economists use changes in the variety of activities to measure the business cycles and to predict where the economy is headed towards. These are basically called indicators. A leading indicator is a measurable economic factor that changes before the economy starts to follow a particular pattern or trend. In other words, those variables that change before the real output changes is called leading indicators. Leading indicators often change prior to large economic adjustments. Change in stock prices and profit margins and profits. Indices such as housing, interest rates, and prices are generally seen as precursors of upturns or downturns. Similarly, value of new orders of consumer goods, new orders of plant and equipment, building permits for private houses, fraction of companies reporting slower deliveries, index of consumer confidence, money growth rate also used for tracking and forecasting changes in the business cycles. Leading indicators through widely used to predict changes in the economy are not always accurate. The leading indicators are not always accurate. Even experts disagree on the timing of these so-called leading indicators. It may be weeks or months after a stock market crash before the economy brings to show the real sign of receding. Nevertheless, it may never happen. The next indicator is known as lagging indicator. Lagging indicator reflect the economy's historical performance, and changes in these indicators are observable only after an economic trend or patterns have already occurred. In other words, variables that change after a real output changes are called lagging indicators. If leading indicators signal the onset of business cycles, lagging indicators confirm these trends. Lagging indicators consist of measures that change after the economy has entered the period of indicators consist of measure the change after the economy is entered in the period of fluctuations. Some examples of lagging indicators are unemployment, corporate profits, labor cost per unit of output, interest rate, the consumer price index, and the commercial lending activity. A third type of indicator is coincident indicator. Coincident indicator. The third type is known as coincident indicator. Coincident indicator, also called a concurrent indicators, coincide or occur simultaneously with the business cycle movements. Since they coincide fairly closely with changes in the cycle of economic activity, they describe the current state of the business cycle. In other words, these indicators give information about the rate of changes of the expansion or contraction of the economy more or less at the same point of time it happens. A few examples of coincident indicators are GDP, that is the gross domestic product, industrial production, inflation, personal income, retail sales, and financial market trends such as stock markets. Let us do some notings about indicators. Indicators. Economists use changes in a variety of activities to measure to measure the business cycle to measure the business cycle and to predict and to predict where the economy is headed where the economy is headed towards. These are basically called indicators. These are called indicators. There are three types of indicators. There are three types of indicators. First is leading indicator. Leading indicators. The second type is known as lagging indicators. Lagging indicators. And the third type of indicator is known as coincident or concurrent indicators. Concurrent indicators. I believe you are understanding everything. Let's begin with the first indicator, that is leading indicators. Let us begin with the first indicator known as leading indicators. A leading indicator. It is a measurable economic factor. It is a measurable economic factor that changes before the economy starts to follow a particular pattern, starts to follow a particular pattern or trend, particular pattern or trend. It represents variables that change before the real output changes, before the real output changes, that is, prior to large economic adjustments, prior to large economic adjustments. Write few examples associated with this. Examples: changes in stock prices, changes in stock prices, profit margins, and profits. Indices like housing, interest rates, and prices, etc. Are generally seen as precursors of upturns or downturns or downturns. Value of new orders, value of new orders for consumer goods, for consumer goods, capital goods, capital goods, building permits for private houses, building permits for private houses, fraction of fraction of companies, fraction of companies reporting slower deliveries, index of consumer confidence, and and money growth rate are also used for tracking and forecasting tracking and forecasting changes in the business cycle. Changes in the business cycle. So this was about examples. Let us see the demerits. Demerits of leading indicators. Leading indicators, though widely used to predict changes in the economy, are not always correct. Not always correct. Experts disagree on the timing of these leading indicators. The next is lagging indicators. The next is B, lagging indicators. It reflects the economy's historical performance and and changes in these indicators are observable only after an economic trend or pattern has already occurred. Next, it represents variables variables that change after the real output the real output changes. That is measures that change and after that economy has entered a period of fluctuations. If leading indicators if leading indicators signal the onset of business cycles, lagging indicators confirm these trends. Take few examples. Unemployment, unemployment, corporate profits, corporate profits, labor cost per unit of output, interest rates, interest rates, CPI, consumer price index, CPI, commercial lending activity, etc. The next indicator is coincident or concurrent indicators. It coincide it coincides or occurs simultaneously with the business cycle movements. Business cycle movements. It gives information about the rate of change of the expansion or or contraction of an economy, more or less at the same point of time. It happens. Third, it coincides fairly closely with changes in the cycle of economic activity. and describes the current state of the business cycle. So concurrent indicators describe the current state of the business cycles. Current state of the business cycle. Few examples in relation to coincident indicators or concurrent indicators. Gross domestic product, gross domestic product, that is GDP. Industrial production, inflation, inflation, personal incomes, retail sales, retail sales happening in the economy, stock market prices, financial market trends, financial market trends like stock market prices, etc., etc. So this was about coincident and concurrent indicators. Let's see what we have done in today's class. So as per the stages of business cycle, the fourth stage was depression. We have seen the fourth stage in detail. Then we shifted to the fifth stage because after depression, the recovery comes. So how does the recovery happens or how does the economy recovers? We have seen that in detail. How a economy recovers from depression or through. Then we have seen the indicators, that is basically three types of indicators were there: leading indicators, lagging indicators, and coincident or concurrent indicators. So leading indicators, lagging and coincident indicators. So this was the whole example and write up about the leading indicators. Then we have seen the lagging indicators, and at last we have went through the concurrent indicators. We'll keep it till here. We'll keep it till here. We'll resume from here in the next class. Thank you.